Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode of Between Two Chairs. My name is Fernando Arencibia, and with me, as always, is the freshly coiffed Jennifer Woolman. Jennifer, say hi.
Hi, everybody. I got a haircut. That's why he's saying fresh.
There you go. There you go.
Shout out to Silvana at the Curl Whisper on Coral Way. She's amazing if you have curly, frizzy, or crazy hair. Fernando, I don't think you'll be going anytime soon.
Excuse you?
It's not that curly.
How dare you? How dare you? This is an audio medium. Nobody needed to know. All right, my friends. So we are entering a new year in 2026. It's always that time where there is a lot of hope in the air and a lot of expectation for. Right.
This is actually our first episode of 2026. It is episode number 142 of season 4. So we're on a roll.
I love it.
I didn't even realize it's January 1st for the release.
That is incredible. I love it. And the fact that we're releasing today, January 1st, is really, really impactful. I think you and I probably are of the same mindset that I don't know. Do you write New Year's resolutions?
No, they're mostly I guess you'd consider it my business goals that we do October, November, and December. Those are kind of my New Year's resolutions.
Yeah, and you're always sort of restarting them. You're always writing new goals every quarter. You're always growing. So, this idea of writing these resolutions at the beginning of the year to carry you through the rest of the year doesn't make too much sense.
Right. But a lot of people are adamant and they do their vision boards and everything else. So we usually start the year off with different predictions that we hear from industry experts. So I thought we would start the year off with that, just because the fourth quarter, I can't wait to see fourth quarter numbers for South Florida, but just based on what we saw and the amount of deal activity between executed leases and, properties going under contract listings coming up, the fourth quarter definitely saw a lot more movement, which I think could be a really good predictor for 2026. I have to get used to saying 26, especially in light of the December 10th, rate cut. It wasn't huge. I was a little bit surprised, quite honestly, because depending on what happens this year with Powell's replacement, I thought maybe he'd think the person's going to cut too fast, because we're still kind of in that iffy, right? There are a lot of indicators showing that inflation's gone down, but there's still groceries overall are high. The cost of living overall is high. Yeah, gas has gone down,
Well, and in the last cut that he made last year, he insinuated that there would be maybe only one more cut for 2026, which to a degree, we've always spoken about the fact that markets don't like uncertainty. So one way or the other, that provides a certain amount of certainty as to where the market is going to be interest rate wise. And I think it's important for us to talk about the fact that there are, this time of year, a lot of predictions from, all over the country. And some predictions are really at the macro level of the economy. Mm-hmm. And what we want to talk about today is where we think things are going to be in South Florida. But to your point, it really is super interesting how when you have your pulse on the market, you kind of see how with the activity going up and the amount of deal flow and the amount of attention and a lot of new listings and all that other stuff, you really get a sense of when things are moving and when things are anecdotally more sluggish.
Right. And I thought it was interesting because I know the Counselor of Real Estate put out their predictions,
right,
and PwC and the Urban Land Institute put out their predictions. And it's funny because they each had 5, and they're very, very similar. So the 5 topics for the ULI report was half full or half empty, capital markets in a fog. Niche to essential real estate, back to basics, demographics will define demand, and the 5th one was AI moves into real estate. And with the Counselors of Real Estate, it was fiscal and monetary policy, which can correlate with capital market, portfolio risk, which they didn't have in the other one, back to fundamentals, back to basics, capital sources and flows. I guess that one would be more comparable to the markets in a fog. And then transformation of real estate through tech, which again, so they were very similar. They had different reasons, and different insights as to what was going on. But I think it's pretty interesting that, 2 totally separate, well-known, well-respected groups put out their outlook at the end of last year, and they were very, very similar in terms of topics.
What, if I may, just because my mind is very curious, what did they mean by going back to basics? Did they elaborate a little bit on that on the ULI side?
So on the ULI side, it was going back to looking at local, the local markets, that you can't just be looking at the cap rates, that you had to do a broader underwriting.
Yeah.
And it's funny because the Counselors of Real Estate, it was similar. They had a lot built into risk analysis. So they said that's where it's kind of different, is the type of risks. Before it was more location and monetary risk. And now in addition to those, there's a lot of climate factors. And with AI and with some of the people that have significantly increased their purchases of commercial real estate, the underwriting is getting a little bit different. So I thought that was...
Well, you know what I thought of when I heard the word more to the fundamental side with the Counselors of Real Estate is, I think it would have been 2 years ago that we went to a presentation by... I think it was the Atlanta Fed, if I'm not mistaken, and they were talking about a big concern that banks were having with valuations, and the appraisals, and how they would send out portfolios to 7 different appraisers and get 7 different prices. And so I feel, the market is as such where that wouldn't happen necessarily today, where there would be more consensus on valuation, more consensus on, more a sense of understanding the fundamentals of the, and having clarity as to the, performance of those assets.
Well, to your point with the ULI report, what they were saying too is that it's also the operators of these assets have to get back to basics, which means they have to maintain the quality of the facility. They have to really work on the experience for the for the tenants and the tenants' consumers within their space, and navigate rising costs, because there was a lot that they were saying, especially with older properties, that, the cost is going to be expensive. So that was kind of the back to basics there.
So let's talk a little bit about the capital market and from the point of view of we have rates that are stabilizing. They're in decline, but they look like they're going to be stable throughout the year. Will we see renewed institutional buying? Especially on industrial multifamily, will still be, I think, 1A and 1B, 1 and 1A on the interest from those institutional investors. Interesting to see how much we're going to continue to see a flight to quality, not only on the office sector, but I think just overall, people are looking for. It's really interesting because on the residential side, we've heard a lot about a wave of younger buyers who don't want to have to do anything to the property, but we're also seeing a flight to quality on the commercial side, especially from institutional investors. And another thing that's going to be interesting is that, and I don't know exactly who monitors this, but I think that there is data to suggest that there are a lot of family offices that have moved to Florida. And so I wonder if we're going to see a lot of them being very engaged in the commercial market. We'll see more cash deals outbidding some of the traditional investors. I think that those things are going to play an interesting role here.
Well, and I think we've seen that already, especially at the end of the fourth quarter. I think the main issue is still because Florida and South Florida in particular is doing better than a big chunk of the overall. When you hear national headlines that there's a lot of debt coming due, CMBS loans that are going to default, et cetera. True. And you start hearing all of that. But when you bring it down to the local level, we haven't seen a huge issue yet. I'm waiting to see what happens with some of the multifamily, because a lot of, especially the older multifamily, was sold at the peak of the market with low interest rates. And so when those come, you don't know what that's going to look like. But there is still, at least on the retail side, I think, I don't know, you know multifamily better than I do, but on the retail side, I was doing comps the other day for some land. Somebody wants to, sell some 6.5 acres up in the Fort Lauderdale area. And so I was running comps and looking at everything that's sold in the area. And all of the major sales were retail. And big retail, 26 million and above. So I was looking at that versus the smaller retail that I tend to do down in Miami. And on the smaller side, on the institutional side, I feel like the numbers have the sellers and buyers tend to come to an agreement faster, or maybe not faster, but they tend to come to an agreement. Whereas the smaller owners, especially that have owned a really long time, they have really high expectations for their numbers. And when you're looking, a lot of our core properties in the near downtown area, and I'm not talking about Brickell, I'm talking about the surrounding, Rhodes area, Little Havana, Coral Way, kind of those areas, Allapattah. They have older stock, right? Older buildings. So they've probably undergone their first 40-year, maybe their first 10-year research. Now they're up for another ones. And you're looking at that, and the seller's like, oh, well, I can get so much money for this because of everything going on. But then you look at the numbers and what the property could rent for and how much work they're going to need in order to get that property back up. And I think there's still a bit of a disconnect there, especially since a lot of these owners are people that aren't in a financial strait, right? They just want to retire or sell or move, but they don't need to, but this might be their big retirement nest egg. So I think we're going to see more of that. And to your point with family offices, I think we're going to see some family offices that have maybe been real estate heavy in Miami. If the next generation isn't interested, maybe selling and reallocating some of those assets. So I don't know. That's just something that I got a little bit of at the end of the quarter.
Well, and then maybe the prediction about going back to fundamentals does become true. And some of those sellers that are not really sellers because they're not pricing it at a level where the fundamentals will garner that price will kind of either readjust or go away. And then the people that come into the marketplace will actually come in at a price where that makes sense.
And I think it's going to be interesting to see how that plays out, because I think right now we're kind of in balance. We're not seeing a lot of distressed sellers or people who can't refinance, because a lot of those are low interest loans that are going to get ready to come up again haven't come up. But I think when that does, that could be an interesting shift for the market, because if they have to sell, that could push the prices down a bit, right? Because people aren't going to want to pay if they don't think they can get the rents, or their costs are going to be higher for the capital.
And the reality is that the majority of those owners have already gained an incredible amount of equity over the last 3 to 5 years. So, they have a little bit more wiggle room to make those decisions, right? Although I've never met a seller who doesn't want to get top
of course,
but it does give you options, especially when you have necessity, and it is a real consideration that people make.
Mm-hmm.
Interesting to see that, I think population growth wise, I think we're gonna remain a very attractive place for people to continue to come into South Florida, but also, our own population growth here. So, even though that has slowed down, I think we're going to continue to have net positive, migration. Interesting how I read somewhere about how there continues to be support for the 15-minute city, which, we've covered here before, a walkable place. And, you look at Doral, downtown Miami, obviously Brickell, Aventura, Dania Beach, West Palm, where we're seeing a lot of that, happening. And there seems to continue to be something really interesting happening, which is that about 10 years ago, I remember having conversations with employers and, people that were trying to incubate innovation companies to be here in South Florida. And a big part of what they were lamenting is that the talent would leave South Florida. People would go away to college and stay wherever they got their degrees. And so there would be almost like the inverse of what's happening now. There continues to be new companies that are coming in here, a new talent migration that is coming into South Florida. So that's really an interesting dynamic as well. I think that all of the new, and this kind of moves a little bit into office, but I think all of the new buildings that are being created, and I think the numbers for the Griffin office tower keeps going up. I think now it's up to $2.5 billion. So you could imagine the level of amenities, and I know it's not in the South Florida market, but like Chase Manhattan just did a $3 billion behemoth of an office in New York that has everything you could ever imagine you would want as an employee. So I think that will continue to put pressure on landlords to upgrade amenities. So, those that are in the Class B space, but they're in a Class A location, and I'm thinking of like Blue Lagoon, right? They're going to have to continue to pour lots of money into those buildings.
Yeah, and the issue with Blue Lagoon is it's not really, you have to leave the Blue Lagoon area if you want to go out for lunch, and we had that discussion earlier about the differences, where the neighborhood is the amenity. So if the building isn't in a neighborhood that is the amenity, then they have to create the amenities almost within the building.
Well, interestingly, they're creating it not only within the building, but within the communities. It's almost like they've subdivided all of Blue Lagoon, which is bigger than people expect, into areas, and then they're bringing in food trucks. They're doing a lot of activities because they understand the value of that. They also activated a lot of ground floor retail that was not activated before, and they made basically partnerships with operators of food and beverage operations to be down there, to provide quick service, and then to also provide something a little bit more in demand. So that definitely is interesting. I keep having this conversation about moving into a little bit of an office, is this idea that we're going to see a lot of conversions of Class C buildings into residential or hotels, or, I just don't see it. I see more of a conversion to maybe medical use for office spaces that are not ready for that. It still is going to require a lot of investment on the plumbing side, but I just feel like the market, when they continue to talk about this, they're trying to put a round peg in a square, or a square peg in a round hole. The numbers just don't pan out. And I don't see appetite from the administration at a national level to provide such an incredible tax incentive that it would make sense to do so, However, I think this year we would expect the same kind of trend that we're seeing, flight to Class A, Class B if it's very well kept, but Class, lower area, the lower side of Class B and Class C will continue to move. I think that there's a trend that's here to stay, People are looking for wellness. They're looking for like a hospitality style service. I think those things are going to become kind of non-negotiable, and and they want to have a little more flexibility with their lease. So that's going to be an interesting dynamic, I think, to see finally where all this goes with the office. It's only so much that you can keep a classy building half.
Right.
What are you thinking? I mean, industrial is going to continue to do extremely well. I think to expect growth in rents is going to be difficult. We've had great absorption of the Class A, industrial that has been built in South Florida. I don't think that rents are going to fall, but I think that they are here to stay in that range.
Well, we have seen them all in some areas, right?
Yeah,
in Doral, they've come down from the peak that they were at. Not significantly, but enough where there's more concessions too.
Yeah. It's minute compared to the growth that we've experienced, right? And so, so there is a little bit of a leveling off there, which is interesting. So, I think there's more normality and expectation. I do believe that there are a lot of leases that were signed in 2020 that were coming due in 2025. And, people had to make a decision as to stay or go. And I've seen a lot of people decide to move out just because there was such a shock in a difference in price for them. But I think anybody coming into the marketplace right now is, they understand that they're going to be in that $19 to $21, $22 range or higher in some cases. Obviously there are outliers like cold storage and, specialty properties that are going to demand a little bit more, but it's going to be really interesting how the fact that industrial really became such an incredible asset class from an investor perspective during the pandemic. I don't think anybody was expecting.
Yeah, no, it became the darling. Or
absolutely.
But before it had been kind of an afterthought. No, everybody went into.
No doubt.
One of the things that both of them talked about, and I know it's a little bit different here because we still have net immigration, but was the effect of migration, especially international migration in general, as it applied to the U.S., not only demand market, but labor market, and especially construction, and how difficult it is, especially given the current policies, that kind of people from not inside the United States, non-Americans, are questioning, do I come, do I stay, do I put money in, do I not, all based on what's going on. And they've seen a big effect in terms of labor shortages across construction. They expect that that's going to become even more heightened, in 2026. It's going to be a bigger issue just because of where we are in the real estate cycle. So all of that kind of pushes these issues further down the road, right? Because maybe,
no doubt,
for example, like with multifamily and industrial, because we had such a big buildup, they're not building as much now. But as that goes getting absorbed, people who would be starting construction for the next cycle are going to have a labor challenge, and that's going to further drive up costs. So,
well, and I think it's going to have an effect on, from a brokerage perspective, trading, development, land. And land, there are many opportunities for land that is ready for development. We have our own project that has, it's shovel ready, plans, everything is ready to go. Impact fees are paid. I mean, we're ready to break ground day one. But, people are concerned about the cost of construction. People are concerned about labor shortages and what that does to a deal when the margins are very tight, which seems to be. And I think only the best located projects are getting the right, the right attention. So I think what we see more in development is perhaps more public-private partnerships, transit-oriented developments, those kind of things. Just because, there is more meat in that bone, if you will, just because of usually those projects are at a larger scale. And so you have economies of scale working on your side. But I think it is a big concern to look at that. I am really interested to see, we're going into an election year for midterm elections. Does the rhetoric get cranked up more? What happens by the time we get to November? There seems to be more understanding about the tariff situation, more, I would say, structure centered around it than there was at the beginning of the year, which I think was a shock to the system. So I'm really interested to see how those things play out. If the market really does feel like there is some level of certainty, and if there would be maybe more of a balance by the time we get to November, who knows?
Yeah, one of the things, and just to go back to the lot that you were talking about in Sweetwater that we have that's shovel ready, is one of the things that they both mentioned is that, during COVID, there was this flight for construction in the suburbs and more greenfield development and everything else. And they said that now there's going to need to be a shift to more infill. And the Sweetwater is a great point.
Right.
It's in a location that already has density. It has other services versus maybe building some of the stuff that they started in further out areas, just because traffic everywhere, especially in South Florida, is a bigger quality of life issue. And the transportation oriented developments have all been mostly for rental housing. So, are we going to start seeing some of these projects do condo conversions for the newer, there's still so much demand to purchase. It's just a cost and supply issue the cost of money for people who want to buy residential real estate versus the pricing, right? Yeah. And here we have all of these old condos. So for people who want to come here and work, and for people who want to bring their companies here, I think that's an interesting alternative too. Could somebody start doing some condo conversions with some of the newer inventory at a more affordable level, because most of our new construction is for the ultra high net worth. They're very high end.
Well, and there are things that are happening that are very specific, hyper local specific here to South Florida, and through the state of Florida that we're going to monitor, because I think, it's going to be interesting how the full elimination of the business rent tax will it have an effect into the tenants expanding their footprint? Is it going to incentivize small businesses to, to do more? Sometimes small businesses expand without expanding their footprint. They just invest more into their business. So, it's going to be really interesting to see that. Definitely Live Local Act 2.0 continues to be, an important piece of legislation that continues to encourage development. I think whoever was monitoring the number of projects that are Live Local Act, 50% of all projects are here in Miami-Dade County. Or in South Florida overall. So it's really interesting to see how different municipalities are affecting how it is being fully implemented. There seems to be more of an embrace down here for those projects. And then, really to see if municipalities are going to do some sort of overhaul in their zoning and planning processes, And
I think we can't underestimate. I'm really looking forward to not to rush through 2026 since we're just at the beginning, but I'm super interested to see how the World Cup affects a lot of stuff, like just the demands for logistics to have the World Cup here, right? And moving all over the United States, but specifically for the number of games and the fans that we have in South Florida and the people coming here. I'm super interested to see how that affects. I think we're going to see, if you have a space that hasn't been leased, maybe consider doing a short-term rental and jacking up, because all of these teams and companies that support the teams and companies that support the practices and the fan events and all the other stuff surrounding what FIFA and the World Cup is going to do in this area. I think that's going to push our numbers up too. So overall, I think 2026 is looking like super bright.
I'll say one more thing, because I think it merits speaking about, which is, you're talking about fundamentals, and we're talking about all these shifts that we're seeing, or some permanence to the shifts that we've seen in the past. I do believe that it is very important to monitor the effect of AI into the commercial, real estate sector. And I'm not just talking from a brokerage perspective. I'm talking about the actual running of the efficiencies that you are creating in managing the spaces, curating the spaces. It's going to be really interesting to see, because I think we're at a point where there is such a widespread adoption that now it's about, zeroing in on how that can have a positive effect. And I think last year we saw that there was a lot of effort being made as to running the properties more efficiently, especially when you have rising insurance costs. It forced a lot of those landlords to say, where can we be more efficient in running these properties?
And what can we do to harden the properties, right? I saw a lot of condos that were, industrial condos or office condos, more likely, that, the fees were going up because to insure the building and everything else. But if they went in and they redid their windows and they did some basic changes, their insurance went down enough that their maintenance fees went down fairly significantly, a couple $100 a month for each space. So I think that's definitely a positive. It's a short-term pain thing, right?
Yeah.
But eventually it's better for the whole, not just for the building, but for the whole area, and adds other efficiencies such as,
for sure,
energy savings and everything else.
Yeah. And to your point, I think that there is great optimism about 2026. I think 25 will prove to be sluggish. I think to your point, fourth quarter, we will start to see that trend shifting. And I think the first 2 quarters of the year are going to probably pan out to do the same thing. And, we'll see where we end up at the end of the year, but definitely excited for another year of working with you, partner.
Yeah.
And definitely excited for us continuing this little project of ours that really comes from our heart, which is this commercial real estate podcast, Demystifying Commercial Real Estate. We hope that we are adding value to you, our listeners, and we love to hear from you and to get your feedback. So I appreciate you listening in. Have a wonderful and amazing and prosperous and healthy 2026. So for Fernando Arencibia, on behalf of my partner, Jennifer Woolman, Jennifer, say bye.
Bye. Look forward to seeing everybody around.
Bye-bye.